Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hope all of you had a very beautiful day of trading today. And in today's markets, guys, well, we got the much anticipated pullback that we've been talking about on the channel for approximately the last 2 weeks. We'd been noticing that the bulls looked a little bit tired at the all-time highs, and especially over the last 2 days when the entire rest of the market was kind of pulling back, the S&P was only really being upheld by big tech names. And that is where the problem lies, guys. It can't last forever. And unfortunately today, big tech rolled over as well. There was really no news in terms of today's sell-off, just a healthy technical pullback in my opinion. So hopefully all of you have been heeding to my non-financial advice and been building a little bit of cash reserves, not getting too greedy at the all-time highs with your call options, because now we're going to get to go shopping for some of our favorite companies. So in today's video, guys, I have a few things prepared for you. Number one, we're going to go through 2 corporate earnings that came out today. We're going to be taking a look at Tesla, of course, and Coca Cola. Now, obviously, guys, this week is packed with earnings. We can't cover everything. So I'll be covering, in my opinion, which are 2 of the most important earnings of the day. Coca Cola, which gives us some insights into the health of the consumer, and Tesla, of course, well, because it is part of the Magnificent Seven after all. So we'll be covering those earnings first. Thereafter, we're going to get into our technical analysis rundown of our major stock market indexes, followed by our big tech names, see if there's any opportunities to be had there. And lastly, wrap it up with a few little trade adjustments that I made today. And that is pretty much everything, guys. So a lot to cover in today's video. Let's jump right into the action. SPY down about 0.91%. QQQs down about 1.53. It was a little bit worse than this. The QQQs were down almost 2% on the day at the midpoint of the afternoon before we got an end of the day rally. But you can see by this list here, guys, all major sectors ending in the red today, and you can tell by the heat map as well, right? Led to the downside by big tech names, NVIDIA, Microsoft, Apple, all of them pretty much pulling back, and some multiple percentage points. Now, we did have some beautiful green spots in consumer defensives, Walmart and Costco holding their own. Financials, still a little bit weak, but no massive sell-off there. Healthcare, the same, still a little bit weak, but no massive sell-off in the sector. And the bottom half of the market, guys, other than real estate and utilities, extremely mixed picture, right? So a lot more names were red than green over the course of the day today. Now, in terms of your one-day relative, you can see that even better, only real estate and utilities etching out some gains. The entire rest of the market down and led to the downside by technology and consumer cyclical, which leaves us at a 1-week relative performance, guys, that looks kind of weak, right? So in terms of your 1-week relative, only tech has been holding up the market as best as it could before today's rollover, and the rest of the market ending up in the red. So this is a pattern that we've been noticing for approximately the past week, and I would not be surprised if this leads us into a little bit more very healthy weekly consolidation after 6 weeks worth of rally. Extremely logical pullback on today's session, if you ask me. Now, before we get into more technical analysis, guys, let us dive into our earnings. And we're going to start it off with a pretty good one, which is Coca Cola. So Coca Cola coming in on the day, and they were actually down a ultra rare 2% at one point on the day. They were down over 3.25%. Very rare for Coca Cola, actually 4%, but it didn't last for that long, right? Pretty much just at the open would you have those numbers for about, all of 3-4 minutes before we had a recovery, right? But as the most part, you might have seen Coca Cola down about 3% on average through a good portion of the morning. So what exactly happened? Why was Coca-Cola down? Well, let's have a look here. In terms of the most recent quarter, they actually did quite good. Beat on the bottom line EPS by 3.32% and a beat on revenue by approximately 3% as well. So why is the stock down? Let us take a quick look at the article real quick, and then I'll give you my thoughts on the stock. So Coca-Cola tops earnings estimates as higher prices offset sluggish demand. Keywords here, sluggish demand. We've been noticing this by Coca-Cola and Pepsi and a lot of other companies, of course, over the last 3 quarters. And this one was kind of more of the same. Let's move into it. Adjusted net sales of almost 12 billion were roughly flat from a year earlier. Coke's organic revenue, which strips out the impact of acquisitions, divestitures, and currency, climbed 9% during the quarter. So very nice to see them still being able to grow that organic revenue. Unit case volume fell 1% on the quarter, driven by weakening demand in some international markets. Consumer companies, including Coke, have reported in recent months that consumers are more price sensitive, leading to a sluggish demand for its products as prices remain high. Inflation, right? The lasting effects of inflation. A set of consumers are exhibiting value-seeking behavior, said the CFO. That shift includes buying fewer packs of Coke products or smaller-sized drinks at fast food restaurants. Now, Coke in recent quarters has been besting rival Pepsi, which has been dealing with the fallout from the Quaker Foods recalls, in addition to a US consumer who has been snacking and drinking less. Now, Pepsi said the volume for the North American beverage business fell 3% in the quarter, which is roughly on par with Coke. Coke was pretty much flat for all intents and purposes, right? But Coca Cola does have one advantage or disadvantage, depending on how you look at it, over Pepsi. And that's the fact that Coca Cola is a pure beverage play. Pepsi, of course, includes a lot of different snacking items, their Frito-Lay business, their Quaker Foods business as well, whereas Coca Cola is only a pure beverage company. And because of the distribution model as well, it tends to have much higher margins and a more robust and resilient model overall because of those facts. Now, Coke's Let's move on a little bit further. Coke's unit case volume in North America was flat for the quarter as shrinking demand for its water, sports, coffee, and tea products offset its growth in its namesake soda, juice, dairy, plant-based beverages, and sparkling flavors. So very mixed earnings as a whole, right? Some of their products are doing good, other products are not doing so good. All in all, led to flat case volume in North America. Unit case volume fell 2% in the company's Europe, Middle East, and Africa and Asian Pacific regions. The company called out volume declines in China and Turkey specifically. Like North America, Latin America reported flat volume. Globally, volume for Coke's sparkling soft drinks like Sprite and for its namesake soda, Coca Cola, were both flat for the quarter. Coke said its pricing rose 10%. Roughly 4% of that increase comes from markets experiencing intense inflation like Argentina, while the rest is the result of price hikes and customers trading up to pricier options. So Coca-Cola still benefiting from a little bit of pricing power, but I think they've reached the point of the tipping point, right? To where they can no longer increase prices any further, or they risk reducing demand in a significant fashion, right? It's a very, very big balancing act for these companies right now. But Coca-Cola even said, as we'll get into later in the article, I think I highlighted this. It's actually down here. They're not going to have this same pricing power moving into 2025, and they touched upon that. They can't raise prices anymore. We see us heading towards a more normalized level of pricing going into next year and landing in a more normal zone that tracks at similar rates to the CPI. So there it was. It wasn't down there. It was right there. For 2024, Coke now expects organic revenue growth of roughly 10%, on the high end of its prior range of 9 to 10%. The company reiterated its projection that comparable earnings per share will rise 5 to 6%. These are both pretty standard for the company. EPS rise every single year, about 5% on average. Revenue of 9 to 10%, though, is quite good. So Coke is projecting a low single-digit headwind for comparable revenue and a mid-single-digit headwind for earnings per share next year into 2025 due to currency risk. But also, just remember, they did say that they're kind of running out of pricing power right here, hinting at a more normalized level of pricing going into 2025. So my thoughts on the company, guys? Well, I mean, Coca-Cola is such a solid company, guys, such a solid stock. It's no wonder that Warren Buffett has been holding this one for a very long time at this point, right? Look at these phenomenal net margins. Nothing bad to say. Coca-Cola usually in the range of about 19-20% net margins, depending on the quarter. And the profile looks quite good for the company in terms of that. In terms of your EPS expansion, very consistent EPS expansion, guys. Very consistent revenue expansion as well. That is what you want to see. Coca-Cola is somewhat of a cyclical company, exposed to cycles in the economy up and down. But you can see here, their business model is extremely well run. They're veterans in the game in terms of being able to adjust prices to the upside, to the downside, cut costs here and there. They are definitely veterans in the game. This is not their first economic cycle, guys. So this one stands to be a little bit more resilient than the most. You can see that expressed by their profit margins right here. Here's your historical profit margins for the company. We had that little dip with Pepsi back in 22 and early 2023, but they're recapturing gross margins fairly good. Operating margins, although they were not what they were at the height of the pandemic, they're now back to more normalized levels. And also your net margins, well, I mean, net margins are pretty steadfast right here around the 20% range. So no big deal there. In terms of the share buybacks, they have halted a little bit on their buybacks. They were very, very aggressive leading into 2018. right? And now they're starting to resume the buybacks once more. So that is also a benefit of a company that generates a lot of free cash flow per year, guys, with those juicy net margins. You can see right here, very decent amount of free cash flow per year, almost $10 billion. And yes, they use a bit of it to service their debt, but a lot of it does go to either dividends, paying almost a 3% dividend for the stock, but also in terms of those juicy share buybacks. So in terms of the valuation of the company, guys, well, Coca-Cola usually always trades. It's very rare that you can find this one on a tremendous discount. You'd have to go back to last October to find this one at a technically undervalued position, right? Moving into it, revenue about 4% per year, 3.6%. EPS growth about 7.4% per year for the next 3 years. Now, where do they stand at $68? They have a PE ratio of about 23.7, which is the historical average for the company. Not cheap, not expensive, right there in the middle. And the PEG ratio, we can't really use the PEG ratio, guys, because the EPS growth is not above 10% on a year-over-year basis. So it comes in at 3.2. I do it anyways just to show you guys why the PEG ratio works for certain companies and not for others. For Coca-Cola, you want to look at the free cash flow yield. Anything around 2.5% is not that great. It means the stock is fairly expensive. Anywhere close to 5% is very good for the stock. So sitting right here at about 3.6, we're right in the middle, right? The stock, for all intents and purposes, is not cheap. It's not expensive. It has a decent free cash flow yield. And if we take a look at the analyst price targets, well, we will see that most of all the analyst price targets are decently above the stock, right? So in terms of where I would stand on this company, as a matter of fact, it is doing one of my favorite trades right now as a whole. So take a look right here. Beautiful monthly rally. We broke out of the all-time high range of resistance, and now we're looking for the infamous breakout, retest, and run. This is a trend continuation trade. So in the event Coca-Cola dips a little bit more, 66, 64, I would be tempted to throw some shares or some call options at this position for a little bit of trend continuation. But just keep in mind, guys, the rallies aren't always this hot, right? It's not NVIDIA. So Coca-Cola can rise over time, but usually you see a more progressive rise over time, something like this, right? This is kind of out of the norm right there, but we can see a more progressive rise over time. So I would not mind buying this company at all, $66 to $64 for a swing trade, but also if it's something that interests you for a longer term portfolio like Warren Buffett, I see no problems investing in such a strong legacy brand like Coca-Cola. So as a whole, guys, even though there are some short-term headwinds, they seem to be navigating this economic landscape quite well, and I wouldn't be too worried about this company on a long-term basis, of course. So that's everything for Coca-Cola. Now, let's move in to the one that everybody wants to see, which is Tesla. So Tesla up about 11-12% now in the after hours after reporting very good earnings on an objective fashion. Even though I am a Tesla shareholder, you guys know that I've had my fair share of critiques for this company over the last year and a half that I've been covering it for you guys publicly, right? I'm a very objective person. Just because I own a certain stock doesn't mean that I have to love every single thing the company is doing right now. And I think that's most important when you are an investor in a company, guys. You need to be able to see the positives, the negatives, and still weigh whether or not it's a good investment for you at any given time, right? So moving in, guys, I took a little bit of time to listen to the earnings call. We'll get into that in a little bit, but in terms of the number right here, the numbers, EPS beat by a substantial margin, 21% EPS beat. And that was going to be one of the focuses of this earnings call, guys, is how are Tesla's net profit margins doing? Because we know that in the past 2 quarters, this has been the main criticism of the company, has been their dwindling profit margins. After expanding their net margins, you can see it's a little orange box right down there. It says net margin, right? So you can see very nice expanding net margins 2021 through 2023. And then over the last couple of quarters, they've been coming down. Q4 of 2023 was a bit of an outlier here, down and down a little bit further, all the way down to about 5%. So this quarter was all going to be all about EPS growth and net profit margins, because those are the ones that stand to affect the stock price the most. Well, I'm happy to report that Tesla did beat very nicely on those bottom line net profit margins, even though the revenue had a tiny little miss of about 1%, but still a miss for Tesla on their revenue. Now let's move into the article, shall we? So Tesla shares jumped 10% on profit beat as company benefits from environmental credits. Now we'll get into those credits as well. Revenue increased 8% in the quarter, which is a very decent number, although they did miss the estimate. Profit margins were bolstered by $739 million in automotive regulatory credit revenue during the quarter. Automakers are required to obtain a certain amount of regulatory credits each year. If they can't meet the target, they can purchase credits from companies like Tesla, which has excess credits because it makes only electric vehicles. These are environmental credits, of course, right? So because Tesla only makes EVs, the company has plenty of excess regulatory credits and sells them at what is effectively a 100% profit. Now, all the other auto manufacturers, guys, they're required to hit a certain threshold of regulatory requirements for environmental standards. And if they do not meet them, they have to buy the credits on the open market. And who is there to sell them to them? Well, of course, it is Tesla. Now, a lot of people criticize Tesla, saying that they could not make the amount of margins that they do without these environmental credits. But what do you expect the company to do, guys, right? This is just the current governmental landscape that we're currently in right now. If you have anybody to blame, it's the government. It's not Tesla. Tesla is just operating in its niche. It's not its fault that it only manufactures EVs, right? Do you want it to not go for the environmental credits? Do you want them to not sell them to other companies for a profit? Wouldn't be a very good business decision, would it, right? So it is a very good segment of the business for Tesla, just as a byproduct of the company that they are. So it's very tough to criticize them for it, right? Now, automotive revenue increased 2% to 20 billion. That's very decent, but a far cry from what we were used to in terms of the automotive ramp, as you can see from the chart down there. The highlights of this one are energy storage, right? Energy generation and storage revenue soared 52% to 2.38 billion. Services and other revenue, which include revenue from non-warranty repairs of Tesla vehicles, jumped 29%. So really doing good on these services, right? The services is the dark blue and energy is the gold period, right? The gold marks right here. You can see it's been a larger portion of their business over the last year and a half. So nice to see them expand into the other segments of their business that are highly profitable segments of the business as well. Really helps bring more money to the bottom line. But as you can see, automotive revenues, guys, still roughly flat or slightly down in relation to the highs of 2023. And everybody's looking to Tesla now to see what is going to be the next ramp. We know that interest rates have been kind of pummeling demand for not only EVs, but cars as a whole, or large ticket items such as houses, obviously cars, refrigerators, appliances, stuff like that. All of that is down. So it's not necessarily a Tesla problem. It's the overall demand for anything that requires financing because interest rates are high, right? But what is going to be the next growth segment for Tesla to really start ramping this revenue? Well, it's going to be the more affordable vehicle, so-called possibly the Model 2. We don't officially have the name, but a lot of people are speculating they'll call it the Model 2, which should be around $20,000 to $25,000 USD for every single car. So a more affordable mass market vehicle that everybody's waiting for, right? Now, more highlights right here. They reached 7 million vehicles produced on October 22nd, which is very, very solid number. The Cybertruck became the third best-selling fully electric vehicle in the US, behind two other Tesla models, the Model 3 and Model Y. So good thing for the Cybertruck, very nice. They've sold more than 16,000 of them in the US. Tesla said in the release that the Cybertruck achieved a positive gross margin for the first time. Obviously, it's very tough to run positive net margins on every single Cybertruck because they're not ramped up to scale. But when they will be ramped up to scale, Elon has reiterated the fact that they will be net margin profitable too, as well as the rest of their other vehicles. Now, while deliveries increased 6% from a year earlier, they fell shy of analysts' expectations and followed 2 straight quarters of year-over-year declines. We can see that in the net revenue sales as well. No secret there, right? Now, moving on. Despite ongoing macroeconomic conditions, we expect to achieve slight growth in vehicle deliveries for the remainder of 2024. So definitely not the growth that we're used to, but at least they are still growing. And most importantly, they're still net margin positive. They have a huge cash pile right now of $33 billion, and they still generate a decent amount of free cash flow. So the company isn't necessarily at risk of bankruptcy or anything like that, right? Tesla is facing increased competitive pressures, especially in China, from companies such as BYD and Geely, along with the new generation of automakers, including Li Auto and NIO. A lot of these auto manufacturers in China, guys, are selling EVs between $10,000 and $20,000. So you can obviously see the need for Tesla to release this new mass market affordable vehicle in a quick fashion because it's losing market share to the cheaper offerings that markets like China have right now. So that's everything for the news article. Now let's jump through a bit of their numbers. And from their earnings slides, we can see here free cash flow of $2.7 billion in Q3. That is very, very good. Cash and cash equivalents now up to $33.6 billion, which is absolutely fantastic. And they had a decent quarter of profit. Their net margins coming back to the levels that we're kind of used to in the past. Here are the key takeaways. We're not going to go through all these guys. It would take me forever. Our cost of goods sold per vehicle came down to its lowest level ever at $35,100. That is the benefit of being able to ramp up to scale. You get better deals on supplies. You get better deals from raw materials as well. It's the benefits of scale and obviously the advanced robotics that Tesla uses in their auto manufacturing process and cutting down a lot on the number of parts that they use per vehicle, right? So Tesla is very, very good at being efficient with their production line. Now, moving in further, preparations remain underway for our offering of new vehicles, including more affordable models, which we will begin launching in the first half of 2025. So it's finally coming, guys. It is finally here. Now let's look into a few more numbers. We can see here total gross profit. Look, I mean, even though revenue's been increasing, right? The total gross profit has slightly tapered back. It's had a few quarters where it was kind of pulling back, but now we're back to decent growth here, guys, right? Very, very decent growth profit in terms of Tesla's business as a whole, in terms of your operating expenses as well. Look, right? They were making less revenue every single one of the prior quarters at the top line right here. And now their operating expenses have been either kept on par. Last quarter was a bit of a balloon, and now they've brought them down. So very, very efficient with their production lines and everything like that, reducing cost of goods sold, which gives them lower operating expenses for increased revenue. So obviously, right? More revenue, less expenses means that they have more net profit. Look at this. Tesla now back to a quarter where they have 10% net margin. So this is very good, a very big increase, at least over the last few quarters, and still a decent increase on a year-over-year comparison by about 8%. So Tesla doing the best that it can with the cards that it's been dealt in the current economic landscape, right? You got to give it to them. This is only one of 3 profitable electric vehicle manufacturers in the world. Them, BYD, and Li Auto. There is no other car company that manufactures EVs at a positive net margin, guys. There is none of them. Not Volkswagen, not Mercedes, not Ford, not GM. They lose money on every single EV they sell. Tesla, Li Auto, and BYD are the only 3 car manufacturers that manufacture EVs at scale with positive net margins on each vehicle sold. So it's important to recognize that, right? Now, in terms of the more highlights, well, growth in vehicle deliveries, growth in the energy storage and generation business, of course, higher FSD revenue recognition as well. More people are looking to add the service onto either existing or new vehicles, and higher regulatory credit revenue, of course, which all leads to higher profitability. So very, very nice for Tesla. And now moving down, the storage, energy storage deployed. Look at this fantastic number. It's not as good as last quarter, but still a net increase over either Q1 or the last 2 quarters of 2023 at 6.9 gigawatts per hour, which is very, very fantastic. 75% boost year over year. Now let's move on a little bit further. As we can see, here is your production market share of Tesla vehicles right here. Excuse me, my head is over the graph. So market share of Tesla vehicles by region, you can see it's been a bit flattening out here in terms of their total market share, but I would say that their market share is still relatively healthy and it will be growing over time, right? There's a very slow market share curve. The use of combustion engine vehicles has to go down for Tesla's market share to consistently increase in a rapid fashion, right? Completely logical right there. Cumulative miles driven, guys, for FSD. Very, very, very healthy chart right there. Over 2 billion miles right now in terms of FSD miles driven. So they're really doing a great job at getting the most amount of miles possible for the eventual robo-taxi rollout, which should be happening in 2026. So very nice increases there. In terms of their energy storage business, guys, look at this, right? Energy and other services and other gross profit. Look at this crazy ramp here in the past 2 years. Here's your energy storage deployments. Look at the last 2 quarters. Fantastic achievements by Tesla, at least on the energy generation front, right? Record gross margin of 30.5%. Powerwall achieved record deployments in Q3 for the second quarter in a row. So very healthy right there. Nothing bad to say about it at all, right? Here's your electric vehicle adoption rate. Look at China. China adoption of EVs. This is not just Tesla. This is the overall EV market, which once again drives home the point, right? Tesla needs to get their butts in gear to get out that cheaper model and start competing with these cheaper Chinese models, because China is adopting them very quickly, and they want to be able to retain those customers from China, right? Here we have some very nice pictures of the robotaxi. I mean, style and fashion, as I've said before when we covered the robotaxi event, it's individual to everybody. Some of you may find that this car is really ugly. Some other people may find it's really nice. I'm of the opinion that it looks quite good. It gets the futuristic appeal, right? It looks like a futuristic car, which is what they're going for. No steering wheel, no pedals, just a screen in the middle there. So I think it actually it looks quite good, but that's just my personal opinion, right? Looks and designs are personal to all of you guys. So I wouldn't expect every single one of you to like them as well, right? Here we have more pictures from the robotaxi event and everything like that. 7 million vehicles delivered. So that's pretty much everything. The Powerwall, of course. So that's pretty much everything that I want to cover in terms of Tesla. I think they did a good job this quarter. So in terms of the earnings calls, a couple more factors that I want to talk about. Elon did say 25 to 30% vehicle growth in 2025. A lot of that is coming from the affordable model. He didn't give anything in terms of possible pricing, in terms of an exact date to roll them out, but everything points to the first half of 2025. He also said that robotaxis at scale should be a vehicle run rate of about 2 million vehicles produced per year, which is fantastic from multiple different factories, of course. And you also, one thing that I found interesting from and I did not know this, maybe a few more of you Tesla enthusiasts knew this, but I did not know this. They've now rolled out the personalized Tesla experience. I mean, I think it's been out now from what they were saying from about 1 to 3 months, but they're getting a really good feedback on it. And what that is essentially is if you have a Tesla vehicle and you've customized the screen layout, the colors, like the interior, the light schemes and stuff like that. If you've personalized every aspect of a Tesla, what's really cool is with the app, let's say that you have a Model 3 at home, and let's say you get a new Tesla, you get a Model Y, right? Kind of like an iPhone, as soon as you jump into the new car, you can literally press a button and all your settings from your former car apply in the new car right away. And it applies to rental cars as well. If you have a Tesla at home and you go out and rent a Tesla from Avis or something like that, if you're on vacation, you can actually just click a button and the vehicle adapts all of your personal settings to the new car. I thought that was really cool. I don't think anybody else does that, right? Now, the big question for Tesla, guys, is of course, is the worst behind us or not, right? Is the worst behind us or not for the stock price, for investors and whatnot? I am more of the opinion that yes, the worst is behind us. Now, obviously, worst is a very large word, right? There's tons of moving parts at play. There's interest rates, there's the EV adoption rate versus ICE vehicles, and tons of other different constraints as a whole, right? But as a whole, I think that they have navigated through the peak of interest rate fear, peak of inflation fear as well, the worst demand that they'd been seeing, in the past 3-4 years. I think they navigated the landscape as best as they could, right? There's very little that they can do to stimulate demand when interest rates for financing are 7, 8, 9, 10%, right? But they were doing the best they can. They were giving incentives for new vehicles. They were also subsidizing interest rates, giving away Model 3s and Model Ys for 2.5%, sometimes even 0.9% on the Model 3s for the time being. So Tesla is taking the hit on that, right? Because Tesla's borrowing money at 5-6% in the open market, and they're financing you directly from Tesla at either 1% or 2.5%. So Tesla's taking that hit in the margins just to get the vehicles out of the door, right? So they did the best they can in the current environment. So I do think that the worst, yes, is behind us, right? We have a lot of good things to look for Tesla as a whole. But as I've said many times in the past, guys, Tesla is a very polarizing company for a lot of investors. People either like the company or love it, or they absolutely hate it. And I'm not here to change anybody's opinion. I will just reiterate what Elon has been saying in the last 3 earnings calls as the stock price has been depressed for the last year. If you're a Tesla shareholder, guys, you probably shouldn't be a Tesla shareholder just for the cars, right? You're a Tesla shareholder because you believe in the long-term vision of the company, attacking multiple different segments, attacking the AI segment with the robo-taxi venture, attacking robotics with the Optimus robot, right? Attacking the production capacity that Tesla has, arguably one of the most efficient vehicle manufacturers in the world, just with how the way that they manufacture their vehicles, the amount of parts that they use, they're building their own custom battery cells as well, right? So you got to give it to them, right? And if you're not in it, if you're not in the stock for those reasons, then you should not be a Tesla shareholder. Those are Elon's words, not mine, but I tend to agree as well, right? Because it can be a very turbulent company. And we know that if they do succeed with the FSD, with the robo-taxi and the energy business, of course, which I didn't mention about 30 seconds ago, but energy business could be huge as well, right? If they do succeed with these things over the medium to long term, the next 5 to 10 years, this company is going to be doing absolutely fantastic, right? It's just if you look at it through the lens of only a vehicle manufacturer and you don't believe in anything else, then yeah, the company is going to look extremely expensive to you and it's not going to look like an attractive investment. And I totally get that, guys. I'm not here to sway you one way or the other. That's completely up to you. It's a personal choice and how you view the company, right? Now, moving into more of the Tesla facts, because I think it's important to cover the facts, right? So some of the things that have been plaguing Tesla, is the worst over or not? Well, slowing sales growth worldwide for all the OEMs. We know that we're now rounding the curve as we embark on the rate cutting cycle, right? USA price cuts, lower margins, but they haven't cut prices in a meaningful amount of time. And now the margins, they've gone from 20% down to 10%, sub 10%, 5 we saw in the last 2 quarters. They're now back at 10%. So we can see, once again, another negative point is starting to round the corner. China price wars. This is still very much in vogue, which reiterates the need for that Model 2 very, very quickly. And stimulated demand in Q2 with 0.99% incentives. That's what we were talking about before. The long-term positives, solving FSD, multi-trillion-dollar robo-taxi business. Everybody understands that. One of the most extensive charging networks in the world. They've been doing a great job of expanding the network every single quarter. One of the most advanced robotics divisions worldwide. This is true. AI supercomputer play, Dojo, into Optimus as well. Mostly Dojo. This one is kind of a little bit of a long shot, but still worth to mention. Solar and energy storage exposure, guys. The business is booming for Tesla, and they're one of 3 worldwide positive free cash flow EV manufacturers. We talked about that. BYD, Li, and Tesla are the only ones. Tesla brand loyalty, and they do have some of the best engineers in the world, not only for Tesla, but also in some of the sister companies like SpaceX and whatnot. And some of the employees are sometimes interchangeable, especially in the executive and management roles too, right? So we can't forget about that too. Now, revenue growth through 2027, about 14% per year. EPS growth through 2027, the analyst estimates, guys, are between 30 and 33%. I took this back to 25% in the event that it's slower into the first half of 2025 than people are predicting. So I'm actually I'm sandbagging the analyst expectations. So I'm going, but even if you use 30%, you'll see it's still expensive. Now, forward P at $233, where we stand right now in the after hours. It's climbed a little bit during the call, but a PE ratio on a forward basis stands at a 97. This is quite rich. And even when we divide it by their EPS growth rate, we get a PEG ratio of 3.88. If you were to take a 30-33, the PEG ratio would still be about a 3.1, 3.2. Still above 3. Still quite high right now, guys. So the company is expensive. I know, because we've talked about it so far for the last 10, 15 minutes. I know where this company can go in the future, guys. But on an objective fashion, the numbers don't lie. The company is expensive right now when we take in consideration the revenue and EPS expansion rates through 2027. Now, could they surprise us with Model 2 numbers and how efficient they are midway through 2025? Sure, and then we will revise this number. Can they surprise us with Robotaxi in 2026? Sure, and then we can revise this number. But I think 25 to 30% EPS growth per year is quite fair, guys. That is an extremely good EPS growth rate as a whole. The one that might be up for change heavily to the upside would be the revenue growth rate if they can really ramp the Model 2 and the robo-taxis into 2026. So objective fashion, guys, the stock price is quite high. Just got to call it out as it is. And I'm a long-term Tesla shareholder, guys. I've been in this company for like 5 years at this point, right? So all that being said, in terms of the technicals, we know it's an expensive company, so we know we have to be a little bit cautious in terms of where we choose to buy this one, especially for the long term. Now, I've been saying for a while, if we do revisit, guys, I was waiting for earnings. We did test it, But if we once again revisit right now, the lower areas, 220 down to about 190, I think there's some decent value there for Tesla, guys. It's sure the PEG ratio would only come down by about 10%, but I think this is a good position to start building a long-term position. If you don't have any Tesla shares and you're interested in the company, not financial advice from me, but if you are interested in the company and you like what they're doing, I think that, 220 down to about 180 to start building a position into would not be the worst value proposition, especially if you're in this one for the next 5 to 10 years. But as of right now, it is still a little bit expensive, but nice to see free cash flow is positive, margins are coming back. So the story of Tesla is the worst behind us right now. I think that it is. Now, obviously, tons of different things can happen. We can have, war in the Middle East, war in Eastern Europe as well, things like that. Interest rates can go back up, inflation can go back up. We can't predict any of these things, right? But for what the company can control, I do think that the worst is now behind us. And I do think that the lows of the cycle for Tesla are probably set right now, right? Obviously, I don't have a crystal ball, but the odds are favoring more so than not, unless the stock market completely unravels, we go into a super deep recession, the S&P and the QQQs go down 25, 30%, well, then of course, Tesla as well will follow suit. But other than that doomsday scenario, I think Tesla should be doing pretty good. So that's everything on Tesla. Spend a little bit more time on this one because it's such a polarizing company. So hopefully I covered it well. I appreciate your patience while we went through that one. Now, moving through the S&P, guys, so let's move into the technical analysis, and we will see that even though we did break a key level, not much has changed. We've been predicting either or outcome, right? So we knew that we were in a very nice daily uptrend for the bulls, and we knew that the higher lows were right here. And I was saying the past couple of days, guys, if we break the lows without making new highs, well, you do have a start of a daily downtrend. But I was also saying, watch this current previous resistance level, newfound support, and look where the bulls bounced today. Well, they bounced at exactly this level of support and the 26 EMA as well. Now, obviously, we can just continue this decline, but the moral of the story, daily downtrend equals very healthy weekly consolidation. So the bulls still have a chance to save this. They came alive in the last couple hours of trading right here. Now, however, the daily downtrend is not finished just because we bounced here. They need to reset into a new hourly uptrend, and only when they have the hourly uptrend, the daily higher lows are set. And then they have to start everything from scratch. Need to reset the daily uptrend as well, or just do the clean V-shaped scenario right now. But as of right now, it does look that we're embarking into a bit of weekly consolidation. And as I said before, anything above 540, just looking for what, guys? A very healthy weekly higher low for further trend continuation. The lower end of which, after maybe 2-3 weeks, if big tech earnings next week are bad, the lower of which can be 565 down to about 560. That'll be a better area of support for the bulls. The weekly 12 EMA is sitting right there as well. So as of right now, little red flag. We lost the daily, but who's in control of longer time frames here, guys? Monthly, weekly, looks pretty obvious for now, right? So we'll keep looking at this one day at a time, but as of now, key point, guys, identify your favorite companies in the market right now, because if we go into 2-3 weeks of consolidation, you want to know exactly what you're going to go shopping for at which price. So that way, when it happens, you're not surprised, even though the markets might be bright red, you have a target and you are going to click the buy button. I can't click the buy button for you guys. So write down your top 5 to 10 stocks that you want to go shopping for in the event we go into 2-3 weeks of consolidation. And when they get to those prices, regardless of what the market is doing, guys, you have to respect your rules and buy the stock down there if that is what you committed to. Because a lot of times what happens is when we get big moves to the downside like this, and you want to buy Google, right? You want to buy Google, let's say, you want to buy Google at 160. And then Google comes to 160, but you see the SPY, the QQQ, the whole market's bright red, and you say, well, I don't really want to buy Google anymore. The momentum to the downside is quite heavy. Maybe I just sit back and wait. And then Google hits the levels, hesitates around for a while, and then just rises. Or it drops a little bit lower and you still don't buy because then you get scared. It blew through your first target. Now it's at your second target and you don't even want to buy down there, guys. Well, you have to respect what you kind of wish for, right? If the whole time that we've been rallying, you've been sitting on the sidelines and saying, I can't wait until we have a pullback. I can't wait until we have a pullback. I can't wait until Amazon comes back to 180. I can't wait until Google comes back to 160. And then it actually happens and you don't buy. Well, we have to kind of respect what we wanted, right? If we're waiting for it for 5-6 weeks and we're mad that we're on the sidelines and then it comes into us, well, I mean, we have to click the buy button, right? So moving on to QQQ. Now, QQQ down about 1.53%, but we know the context as well was a nice daily uptrend, and we were looking for the daily uptrend continuation, but I was telling you guys, if we flush the higher lows here, 488, we were going into a daily downtrend. That's exactly what happened today. So daily downtrend means weekly consolidation is underway. You can see that very clearly. And at this point, guys, anything above 448, looking for a weekly higher low for possible further trend continuation. Now, this one is going to be heavily impacted by big tech earnings tomorrow. It could get a little bit of a boost from Tesla earnings into tomorrow's session, of course, but the big support area first comes at 483 down to about 476, and that is also a weekly level with the 12 EMA. So we're just looking for a bit of a weekly higher low for possible trend continuation. So we'll take it one day at a time. Moving into XLF right now. So XLF down about 0.08%, but not looking too bad. This one is holding up better than most. So we know that they had a beautiful daily uptrend breakout right there, looking for the daily higher low for possible further trend continuation. The bears haven't pulled back too much of the move. I'd say they pull back maybe 25%. I mean, you can use the fib, but you can do this with your eyes too, right? 25, 30 something percent, right? Not 50 plus, you would see it right away. So as of right now, the bulls are looking healthy for a little bit of trend continuation, but in the event we roll this over and flush to the daily downtrend, you should know the expectation is just going to be for a weekly higher low for possible further trend continuation. And that big weekly level is right down here, 45.80. The 12 EMA should be curling into there. So that's the next area that I'd be looking at for the breakout, retest, possible entries, and then run. Moving on to XLV. XLV also continuing on its daily downtrend. So new daily downtrend on XLV. They had it back here. The bulls got an engulfing move. We were looking for the trend conversion to the bulls and they failed. Roll over on the daily. So continuation of the daily downtrend and continuation of the weekly downtrend. But if we are in doubt, always zoom out and we go to the monthly. Who's in control of this chart, guys? A monthly uptrend for the bulls, tons of space, anything above 138. Looking for a monthly higher low for further trend continuation. So if this weekly downtrend continues a little bit further here into the big area of support, which is around that 147, just looking for a monthly higher low. And the 12 EMA is right there. And we have a ton of space, guys. Anything above this guy right here, 138, right? Tons of space for the bulls. And I've said it many, many times before. What are my two favorite plays in healthcare right now? UNH. If UNH, we revisit 550 to 525. Fairly obvious on the monthly time frame what we're looking for here. The trend continuation trade off of prior resistance, which is now support. Very, very easy setup in my opinion. And AbbVie for the exact same reason. Monthly chart right now, monthly breakout, retest, and possibly run. These are two extremely, extremely high quality companies. I think by now you guys know that most of the companies that I look for are extremely high quality companies. I, delve into some plays, some speculative growth plays like ASTS sometimes and things like that. But for the most part, I think you guys know when I publicly say that I'm looking for something on the channel, it's usually a safer play because the last thing I want is for any of you guys to copy trade or follow trade me, which is fine, of course. I'm not, none of it's financial advice anyways. If you want to copy trade me or get inspiration from ideas, perfectly fine. But that's why I know a few of you may do that. So that's why I don't give garbage setups, right? Or garbage companies as a whole. I'm not saying that any of the ASTS is a garbage company or anything like that, but you know what I mean, right? Speculative bets, growth bets, hype plays, right? Those are fun and everything. But for the most part, I tend to give more solid plays when I go through, especially, financials and healthcare, that's for sure. Now moving into SMH. SMH not looking too bad either, although we did come dangerously close to setting up for the daily downtrend. So we know the context, right, was a daily uptrend as a whole. Daily higher lows are set. Went for the trend continuation, but got stopped out in their area of resistance, 260 down to 251. We will keep a close eye if we do ever flush. Now, we did have one semiconductor earnings after the close, which I did not cover, but they did perform quite good, and that was LRCX. LRCX is a semiconductor equipment manufacturer, similar but not the same as ASML. They manufacture totally different machines, but this one is up 5.12%, so could breathe a little bit of life into semiconductors tomorrow. Obviously, Tesla being up as well. Semis could respond bullish in a bullish fashion to that, even though you could argue they have nothing to do with Tesla. It's just the tech trade as a whole, right? Might be benefited tomorrow. In the event it's not though, and we flush, well, daily downtrend is underway. At that point, guys, what are we looking for? Just a weekly higher low. At this point, anything above 214, weekly higher low for possible further trend continuation. I'd be looking at 238 down about 229 right here for the pocket of support for that retest and maybe a second attempt at cracking this resistance. Now moving into the Russell down again today, 0.91%. And this is where you have to get a little bit worried. Well, not worried, but you have to, take a step back right at this current time, because we know that what were the bulls going for? They were going for the daily trend expansion and trying to attack this big area of resistance that we've been struggling with for the past couple of months, which is completely logical. It's the big resistance from 2020 and 2021, right? So now there's a little bit of a problem here because the bears have taken back a little bit too much of the move, 80% almost to be exact. So the best case for the bulls at this current time, maybe just a tightening range. It's going to be very tough for them guys to come back from an 80% retracement and V-shape, and not only V-shape, smash through this huge resistance, right? It's very tough for them to do it. Not impossible, but highly improbable, right? At this point in time, the best estimate could be just a tightening range for the bulls. That's the best case scenario. Worst case scenario is the bears took back too much, lower high into lower low, daily downtrend, forfeiting the daily uptrend, and unfortunately going into a bit more weekly consolidation. At that point, keep a close watch on 215, because if we lose 215, you lose the weekly uptrend as well, and you're just going to come right back here in the support zone, 214 to 207. So I'll pay special attention to this one. I am personally looking to buy in this area, not here, guys, because it's equidistant risk to reward, right? We're in the middle. This is one-to-one risk to reward. Your take profits here and your stop loss is down here, right? So it's not really worth it for us right now. Moving into the Dow Jones down about 0.96% right now. Daily downtrend underway with the rest of the markets, clear as day on that. But we know, what are we expecting right now? Just some very healthy weekly consolidation, guys. 6 weeks of up, 1-2 weeks of pullback, never hurt anybody, right? Dow Jones does it all the time, as a matter of fact, as you can see from the past price action in the past year. So just looking for a weekly higher low, anything pretty much above 40,000, weekly higher low for further trend continuation. Keep a special look on this level right here. 12 EMA is going to be around 41,800. So we'll keep a watch on this daily downtrend right now. But as a whole, even though we are in a daily downtrend, who controls the longer time frames? The monthly bulls and the weekly bulls as well. So no major red flags to speak of just yet. Now let's take a look at one we didn't cover yesterday, which is going to be Bitcoin. So Bitcoin not looking too bad, but it's doing exactly what we anticipated it would do, right? Daily uptrend was looking nice. We knew we were coming into big area of resistance, and I was telling a lot of you guys, right? If you don't have a position from down here, longing it from here is a risky proposition. You're going for the trend breakout, I understand, but the risk reward is not so favorable, and you're longing into huge 6 months worth of resistance. And I was saying the better setup is possibly waiting for the weekly, since we're now in a weekly uptrend. First time, by the way, in the last 6 months. No weekly uptrend here. Definitely no weekly uptrend here. None here as well. But now, first weekly uptrend since all the way back here. So I was telling everybody that the better proposition is waiting for the breakout, the retest of the prior range, right? 66, 64K. And then you have an attempt for a possible swing trade to the upside, right? So that is what we're currently looking at. It touched it ever so briefly this afternoon, but if we continue sliding down into here, I will be looking to build a little bit more of a Bitcoin swing trade position to start attacking possibly the all-time highs again. So as a whole, guys, not looking too bad. The one time frame we need to keep our eye on is the weekly. Give back too much of this move, and we're right back into the gulag, right? But as a whole, the MACD crossing bullish in the past 2 weeks, looking quite decent. Now moving into our big tech names, shall we? So moving into Apple. Apple with a big decline today, but did not break a critical zone, right? The critical zone is really closing below this 227.50 line. If you close a daily candle below here, it really invalidates the capacity for the possible breakout and retest trade, right? You just completely lose the level. But so far, they did not daily close down there. They came down there, got a lot of people a little bit anxious, and now we're back within the range of consolidation, which is a 232 to 228. But if you're in a swing trade right now, going for the breakout retest, just understand at this point in time, the invalidation level is roughly 227.50, close on the daily below there, and you forfeit all of the most recent price action. But as of right now, still looking for the daily higher lows for possible further trend continuation, right? Not looking too bad on the weekly. It's also not looking too bad, but it's very, very tight, right? We know Apple has earnings coming up literally next week, right? Next Thursday to be exact. So not a lot of days of price action before Apple. I would be highly surprised, guys, if we really go on a crazy run in the next week of trading before Apple's earnings come out. Apple got hit by a few things today. Number one, they got hit by some fines that they were levied because of their Apple credit card in relation to their partnership with Goldman Sachs. Apple took a $25 million hit. Goldman Sachs took a $72 million hit. And we also got an article out of an analyst, a very famous analyst who covers Apple in China, saying that Apple's iPhone 16 sales were 10 million units short of the expectation. So that was a reason for Apple's major drop today. Definitely not a good day of news, but I wouldn't say that we've lost any major levels. Just keep an eye though, guys. If we cannot make a new high and then come into the lower lows with the daily downtrend and close below 227.50, prior to earnings, it's going to be very, very dicey. So just be very careful. Moving into AMD. AMD declining today again, 0.77% to the downside. Daily downtrend continues at this point. And now, guys, unfortunately, I have to do it. I know you don't want me to do it, but I have to do it. I have to change that bright green box of support to, unfortunately, a red box of resistance once again. I've changed the color on this one quite a few times, right? Support, congestion, support, big congestion, resistance above, couldn't crack through it, right? As you can see, support once again, support, they made it, and then resistance, and it's just been a very challenging zone, this whole 163 to about 155, right? Now, unfortunately, below it once again, and below all of your short-term moving averages. So at this point, the bears all are in full short-term control, and until we see the manifestation of a new daily uptrend, I'll remind you the key for some daily, a daily push higher, right? What are we looking for here, guys? Well, number one, you need to get the hourly trend back. As soon as you get the hourly trend back, you watch. How long does that hourly trend maintain? Does it maintain us until the most recent weekly lower high? How much of this move can we get back with a daily push? Is it only 20% before we roll over on the hourly time frame? Before we roll over, at that point, if you only get 20% back on the daily, not looking good. The probabilities favor the bears for at least a revisit of the lows or a flush of the lows. But if you get a 60-80% bounce or a full engulfing move, you create enough space for the daily uptrend recapture. So that's just where we stand on AMD. But we have to understand, what are we trying to do right here? The bulls are looking to eventually put a stop to this, set up the weekly higher lows for possible further trend continuation, because we do have the weekly time frame. That is the saving grace for AMD. My preferred way of playing this, guys, is still writing short puts under the market. AMD has earnings next Tuesday, so won't be writing any short puts much before then. But let's say they drop after earnings, guys. I'll be writing short puts in this lower location here, 140 all the way down to roughly 125 all day. I love that range. We haven't seen it in a while, but if it presents an opportunity again, that is where I will be currently looking to do that. So moving on to Amazon right now. Amazon, give me a very brief second. And let's get into it. So Amazon up down 2.63%. No news specifically, to be quite honest with you, right? Now, moving on a bit further, well, daily uptrend was underway. Resistance though, 188 to 190, right? You saw how hard it is for the stock to push through that. It's completely logical too. It's acted as resistance for the stock a number of different times over the course of the year. So now we got rejected. We closed the daily candle below. Daily downtrend is underway. The bulls can save this tomorrow with a full V shape, but it's not looking the best, right? If they do continue this daily downtrend, use this as resistance, lower high, lower low type of thing, well then at that point, guys, we're just looking for a bit more weekly consolidation on Amazon. Going to establish somewhat of a tightening range here between this whole 187, 190 and the lower 180 to 178. But keep in mind as well, guys, not that many days of price action for Amazon until next Thursday, right? One thing is for sure, if we revisit 180 to 178, or let's say we come into there, I'll probably be looking to play some Amazon. And then let's say if we flush for earnings, back down 170, down about mid 160s, similar to what happened last quarter, even though last quarter's earnings were super, super bullish. Amazon's been getting hit the past two quarterly earnings, right? This one, and we've went over them on the channel, guys. The earnings were fantastic, but Wall Street being Wall Street, you know how this goes sometimes, right? If we come down here, it'll be leaps for me on Amazon, so stay tuned for those. Looking at Google right now, Google down about 1.4%, no change whatsoever, guys, right? Very, very, very choppy price action. At this point in time, really trapped between two clear zones, in my opinion, right now. Let's call it 162, and at the high end, 168.90. Very simple. Crack it to the upside, you have a daily uptrend, but running into resistance quickly, 171 to 180. And then at that point, if you crack it to the downside, daily downtrend is underway, and we just resume weekly consolidation, right? What are the bulls looking to do? Weekly downtrend, weekly engulfing move. Now they have enough space, looking to set up the weekly higher lows for possible further trend continuation. And we also know that we're looking, keeping a close eye on this very long and drawn out inverse head and shoulders pattern for the stock, which usually has an 80-85% hit rate in terms of success rates. I would not be surprised if Google has a good earnings cycle, they're able to not only complete this head and shoulders, but maybe even smash this resistance area in one clean shot. If they fail and if they cannot do it and we come back down here, guys, in the 150s, you guys know me, it'll be leap call territory once again for Google. Moving on to Meta right now, Meta down 3.15%. But we know what Meta's trying to do. Even though it looks dire, it is a very big daily downtrend right now. What are we looking to do on the higher time frames? Well, look at Meta. Weekly uptrend, looking for the weekly higher low for possible further trend continuation. And I've been saying it for so many weeks right now. When we were up here, I was not chasing. I was saying I was waiting for my favorite trade, the breakout, the retest, and the possible run. Trend continuation trade, right? And we're almost there. If we come back down a little bit further here, guys, 545, 530, be highly interested to take a swing trade on Meta. But keep in mind as well, they have their earnings coming up next Wednesday. So not that much price action before that time. But if we do come into there prior to earnings, 542, I will bid a little bit into earnings. And then if for whatever which reason, after earnings, for some which reason, we come back down here, guys, this will be possibly even leap call territory for me on Meta, because the fundamentals of this company are fantastic. And the valuation at 560 now is still relatively cheap. Moving on to Microsoft. Microsoft down about 0.68% right now. Not that bad for Microsoft as a whole, guys, but we have to acknowledge the fact that Microsoft can't do it on its own, right? We had a very nice day of 2% upside yesterday, but you remember the whole market yesterday was red, and Microsoft was the only green name for the most part. So I was saying it cannot do it alone, especially when it's coming into resistance, and SPY and QQQ are not cooperating. Do not expect Microsoft to just break through this resistance on its own, right? So now getting rejected a little bit, daily uptrend is fine. If we continue getting rejected, looking for a daily higher low, anything above 413, daily higher low for possible further trend continuation on Microsoft. But same thing, guys. On Wednesday, October 30th is going to be your earnings catalyst right there. In the event we drop down here, I'll be looking for more leap call options on Microsoft. Love this stock, and it's just been sideways for almost the past year at this point. So if we come down the lower levels in the support range, I will be a fan of adding to my long-term Microsoft positions and placing a lot of swing trades in terms of call debit spreads and call options too. Moving into Netflix. Netflix giving a little bit back after the earnings, but completely logical, right? 10, 11%, 12% in 2 days. Huge short-term overbought conditions. And now we're starting to take back those overbought conditions into some healthy consolidation. So daily trend breakout is nice. Looking for the retest right now. Look at support down here. 735 down to about 725 is the region where I expect the bulls to play a little bit of defense before maybe embarking on some trend continuation. In the event they fail and go for the daily downtrend and the gap fill, just understand what we're looking for. Just looking for a weekly higher low for possible further trend continuation. So as of right now, no immediate red flags for for Netflix. Let's just see how they react right there. Moving on to NVIDIA. NVIDIA down 2.81% today. Not the worst showing for NVIDIA, but definitely giving back the gains that we had from on the Monday session, right? But NVIDIA still in a very healthy daily uptrend, guys. You got to see it how it is, right? Daily uptrend clear as day. Looking for the daily higher low, anything above 129. Looking for that daily higher low for possible further trend continuation. So not looking too bad on the stock at all. And in the event we roll this over, guys, what are we looking for on the weekly? Weekly is looking very good. Weekly, just be looking for a weekly higher low for further trend continuation. See how we react at these two levels. 130, 126 is going to be my first area to bid for some continuation. The more conservative bulls may wait for a more extended pullback. And at that point, you're looking at 119, 115 for once again, the weekly higher low for possible further trend continuation. No earnings yet for NVIDIA until the later portion of November. So they shouldn't be affected too much until that time. Moving on to Tesla right now. Well, Tesla, as we just said, right? As we were saying yesterday and into earnings previously in the video, right? Tesla moving very nicely right now, but we're encountering a little bit of resistance here. You can see the share price is in blue right there. Let's put a little line as to where Tesla is right now in the after hours. So coming into the infamous 235, 240 area of resistance, but now the bulls have created a lot of space. Daily downtrend as of today. Big engulfing move, failing the gap fill from the robo-taxi event. So now at this point, a lot of space will be below us as well. Two, in the event we get stopped out here, because we know it's resistance, right? If we get stopped out, we have a lot of space, guys, set up for the daily higher low to possibly smash this one in 2 shots. If we just smash through it right away, you may get what's known as the breakout retest trade. As a matter of fact, let me just put a designated line right here because it's not so much a line as it is a zone, right? If we break through this whole 235, 240 level like this, maybe an opportunity to breakout, retest, and possibly run, reset of the daily uptrend, and possibly getting some new legs for some weekly trend expansion because we never lost the weekly uptrend. The higher low is here, 201. It wasn't looking good, but we did not lose it, technically speaking. So we do still have a slight chance. In the event the bullish tone remains for Tesla and the overall markets, of course, we do have a chance if we crack through 240. Well, the next step If we do that on the daily, the next step is the infamous 260, 270 area of resistance, this red box above us. Now, moving on to Palantir. So Palantir also not looking too poorly today, 0.82%. Sideways consolidation after such a massive move. The markets are bleeding and Palantir is just chilling all the way up here. So we know the context, guys, is a massive daily uptrend right now. So looking for possibly continuation of that daily uptrend. In the event we crack these lows, 40.57, daily downtrend will be underway. And similar to everything we've just been talking about, what are we looking for here, guys? Always look at it in the weekly, right? When you lose the daily uptrend, guys, first reaction for everybody needs to be going to the weekly. Where are we? Well, we're in the context of a beautiful weekly uptrend, looking for a weekly higher low for further trend continuation. Current support levels below us, 39 to 38. The 12 EMA is going to be curling right into there. My favorite way of playing this, guys, if we come back down here, I'll be writing some short puts, $36, $35 looking to accumulate some premium, but Palantir looking very good other than the fact that slightly overbought on the weekly RSI, and the valuation right now is not the cheapest, right? Let's be honest, it is somewhat expensive, and that's coming from a Palantir shareholder myself, right? So all in all, no trade for me just yet. I'm waiting a little bit more for a pullback. So that's pretty much everything we had for today's video, guys. Hopefully you enjoyed it. If you did, consider dropping a like. We'll do the trades tomorrow. Not that many changes. I'll do them tomorrow, I promise. If you're also new to the channel, consider subscribing. We'd love to have you here. We do these every Monday to Friday after the close. And then lastly, if you have any questions, guys, always feel free to leave them down below. Anything you want, stock, technical analysis, options play, you guys know the drill. So I'll see you guys tomorrow after the close. Take care and peace.